The economic outlook remains tough and the possibility for further macro shocks is high. Within the US, unemployment is still at the 9% level, and this has hit consumer confidence. And with 70% of the economy being driven by consumer purchases, growth is going to suffer. But with inflation surprising on the upside, the government's ability to react to this is severely restricted. Within Europe, obviously we're well aware of the sovereign debt crisis, but the concern now is that it has spread from the periphery countries to the core, with France and Germany now stagnating. And crucially, there is a lack of a long-term solution. And over here in the UK, we're not immune. Our banks have £100 billion worth of exposure to struggling economies, and banks aren't lending. Negative economic surprises provide severe headwinds to the stock markets, but those that are searching for yield will use market falls to buy back into the markets. Cash levels are at historically high levels, but obviously providing near zero returns. Within the bond markets, opportunities are harder to find, and in contrast, equity valuations look attractive at these levels. One word of warning, they look attractive because they're based on forecasted earnings, and we may see earnings downgrades. Until we regain confidence back into the markets, market volatility will continue. It's important to remain diversified and be particular with the investments that you pick. It's imperative in times of volatility and uncertainty that your investments together produce steadier returns. This has been tougher to do in recent years, with asset prices moving very much in line with one another. So if we take, for example, the stock markets and oil markets, when people get spooked and we hear another macro surprise on the downside, people will sell their shares and they'll also sell their positions in energy. With this in mind, it's interesting to look at hedge funds. When we've seen swings in the market, for example in July, of 4% intra-month in World Equity Index, and actually it ended down for the month, it's interesting to see that hedge funds were able to produce positive returns. The reason being they can exploit overreaction and profit on the way down as well as the way up. It's a very broad asset class, and actually the best performing strategy has outperformed the worst performing strategy by almost 130% over the last 2 years. So it'll pay to be particular.